afternoon, everyone. My name is Robin Finlay. I'm based in Calgary. Welcome to our update call with Mike MacBain from East Coast Fund Management. And I should say good morning to those in BC. It's still morning there. Thanks for joining us. I think it's a very timely update to go through right now, just based on what's happening in fixed income land. Credit markets and fixed income markets continue to potentially present a bit of a challenge. So I think we have something here that is certainly worth going through in a little more detail if you haven't already. Just by way of review, last year, this fund was up a little over 2%, 2.3% net of all fees. I don't need to remind you where a lot of your traditional long-only rate-sensitive mandates ended up last year. Certainly they were negative, and in some cases substantially negative. The portfolio here, as Mike will explain, is set up in such a way that interest rates really aren't going to be a big concern for unit holders. And there is a fairly good setup in terms of the opportunity set that we'll have Mike speak to in just a few minutes. This fund has been around over 10 years. It is an alternative fund, which, don't let that scare you. It's very easy to purchase. It's just like buying a regular mutual fund. There are no subdocs required. There's no risk forms. There's no income or asset test. It is also available as an ETF under the ticker of RATE. So I just wanted to put those few things out there to pique your interest, hopefully. And now I'd like to turn it over to Mike to take you through the strategy and where we find ourselves in the environment right now and what the opportunity is. So with that, Mike, I'll turn it over to you.
Thanks, Robin. Much appreciated. And thank you for the opportunity to talk, and thank everybody for tuning in. It's always makes sense, I think, to start off these conversations with a brief sort of discussion of the mechanics of how we operate the strategy. So if you'll bear with me for 5 minutes, I think it's an important 5 minutes to start with. So first of all, we're a Canadian investment grade bond fund. The main differentiator between us and everybody else is that we eliminate all the interest rate risk associated with the bonds that we buy. So this slide here is just an illustration of how we isolate that credit yield component of the bonds that we buy. So let's go through it. Corporate bond, I buy that blue box. That's a corporate bond. It yields 5%. Let's say that's an RBC bond, just for example. If I take the close off that RBC bond, the bond has two risk and two return characteristics. The first one is the Government of Canada rate for the 3-year bond, the 3-year maturity of the bond that we bought. In this example, that's 3%. And the second is the credit yield or the credit spread that RBC has to pay me to convince me to buy their bond instead of buying the Government of Canada bond. So the way we eliminate the interest rate exposure is I simply sell short that Government of Canada bond. So in the scenario where interest rates go up, like they did last year, let's say they go up from 3% in this example to 4%. At the same time that happens, the yield on the blue bond that I bought, the RBC blue bond, goes from 5% to 6%. So I lose the present value of 100 basis points on the long position, the RBC bond. I make the present value of 100 basis points on the Government of Canada bond, and net, there's been no P&L impact to our fund, but interest rates have gone from 3% to 4%. And I'm purely left with that credit yield component of the bond that I bought. And that's the risk that I want, because that's not correlated, that's negatively correlated to interest rates in most markets. So that's the first sort of discussion or description of what differentiates us. The next thing that differentiates us is that we optimize the credit exposure that we take on the credit curve. Okay, so what I mean by that is that I'm earning the highest possible return for every unit of credit risk or credit duration that I'm deploying in the strategy. So here, 2 examples. On the left is what a traditional passive bond fund would do with their credit duration risk, and on the right is what I do with my credit duration risk. So bear with me for a few minutes because there's a little bit of brain damage here. First of all, obviously the passive bond fund is going to take rate exposure. I've eliminated the rate exposure in this example because I just want to compare apples to apples in terms of the credit exposure they take, the return they get from that exposure, and the duration risk that they take. And compare that with exactly the same thing in terms of what we do. So first thing, these two blue curves are credit curves. Let's use RBC as an example. Again, so these are RBC credit curves. At the 1 year duration point, the RBC pays 80 basis points for funding. At the 2 year point, they pay 120 basis points for funding, and so on and so forth. So that's the credit curve. Now, if you're a passive bond fund, you're going to buy a 10-year bond all day long. It's roughly index duration. And so buying that 10-year corporate bond, the passive bond fund is going to have 8.5 years of credit duration. If I follow that orange line, solid orange line down to the x-axis. So that's the exposure that passive bond fund is going to take. 8.5 years of credit duration means that if credit yields go up by 10 basis points, they're going to lose 10 times 8.5 or 85 basis points in return. So that's the risk side of it. The return side of it is they get a coupon yield of 172 basis points, and they get this additional 43 basis point roll down or capital gain as the bond rolls down the credit curve. You know, bond math, when yields go down, prices go up. So a year later, the yield is lower. So the price of that bond went up, and it went up by 43 basis points. So we bought a 10-year bond, took 8.5 years of credit duration, and earned a total of 2.15% in return. Okay, so that's what they would do. So compare that to what we do. We want to be positioned at the optimal point on the credit curve to earn the most return for the duration that we're taking. That is at the steepest point of the credit curve. So where those bonds roll down the credit curve fastest. And in this illustration, that's at the 2 year point. Right? So I want to buy a 2 year bond. Problem of buying a 2 year bond is I've only got, you know, the present value of 2 years of credit duration exposure, which in comparison to the guy buying the 10 year bond is less than 25%. So instead of buying one 2 year bond, I buy four. Now, buying 4 2 year bonds gives me about 7.5 years of credit duration exposure. Okay, similar to the 8.5 that the guy buying the 10 year bond is getting. But what it also does is it gives me 4 coupons. So 4 times 116 is 4.64%. And it gives me four capital gains as each of those bonds rolls down the credit curve. So my return from taking a similar amount of credit duration, we'll talk about the differences in a moment, but the similar amount of nominal credit duration is 6.8% versus his 2.15. Now, the other benefit that I see from this is my exposure is at the 2 year point. So in 2 years, my bonds are going to mature. And that's way faster and a much more certain outcome than someone that owns a 10 year bond. It's got to wait 10 years for that to mature. And so not only have I got a better return dynamic, but I also have a lower beta credit product in most markets. So I just wanted to start with those 2 slides, and lots of you have heard it before, but I want to make sure that we're all on the same page before we dive into the meat for the rest of the presentation. So last year, 2021 to 2021, we were talking about the 60-40 portfolio and saying that in our December 2021 podcast, we talked about this is headed for not a good outcome. 2022 proved that that was not a very good outcome. Worst outcome since the 30s and the third worst on record. So where does that leave us coming into this year? So in our December 2022 podcast, we're trying to find out the general consensus around equity markets. And basically everybody said pretty much the consensus was that equity markets were going to be difficult, unlikely to get much return. You know, Barclays here, inflation is unlikely to fall quickly in 2023. Deutsche Bank, risk still weighted toward recession. HSBC, we remain decidedly risk off. BlackRock, central banks are on course to over-tighten policy, underweight developed markets, and so on and so forth. So that's kind of the backdrop coming into this year. Consensus for sure was that the equity markets or risk markets were going to struggle. So then where were people showing signs of interest, or where people thought the consensus was that the asset class where you should be invested in? And it was an investment grade credit. So here's similar comments from a number of people in investment grade credit. So the 1 to 3 year investment grade space represents a high quality value opportunity. That's State Street. Relatively insulated from an economic downturn. Goldman Sachs, Templeton, seeking relatively safe return in investment grade companies. Bonds are back with a focus on high quality. Probably investment grade credit is the place to be, HSBC. BlackRock, the case for investment grade for investment grade credit hasn't often been brighter. So, just a few snippets on, what we think the consensus was coming into this year for IG credit. And these two charts kind of explain why. So the first one is a chart of 3-year Canadian bank deposit note spreads, and you can see they're elevated. So since 2010, they've rarely been higher, maybe on 2 occasions, and one of those was COVID. And if you look at the chart below, that's the all-in yield of investment grade 3-year Canadian bank deposit notes. So you can see, we're at least double, and in the case of 2021 and late 2020 and early 2021, we're 5 or 6 times the return you could achieve in investment grade credit on an all-in yield basis. So that's going to be very supportive of credit spread. I know we don't take any interest rate exposure, but the fact that you're able to receive a 5% coupon on a deposit note, that's the kind of environment that brings buyers into the fixed income market. So if you think the equity market's a bit of a scary place to be, and the high yield market along with that, which generally was the consensus coming into this year, and if you think investment grade credit's also a good place to be, it is a good place to be for this year, then the question is, who do you want to do it for you? And so, we have a long track record in this space. We've got weekly liquidity and daily liquidity through the ETF. We're an investment grade credit portfolio, no net high yield exposure. We hedge out all the interest rate risk in your portfolio, so you don't have to worry that you're going to wake up one day, rate's going to be 200 basis points higher and you're down 10%. And so we think we have a very interesting product, and I'm going to take you through that now. So here's some return comps for 2022 and over a 5-year period. So we're a little over 2% last year, which, on an absolute return basis, maybe, no one's singing from the rafters about it, but on a relative return basis, people certainly are. So government bond ETF down 12%, corporate bond ETF down 10%, Manulife down 9%, PIMCO down 7%, and PHN's high yield fund down 5%. And that was just last year. And if you compare over the 5-year period, again, we stack up extremely well, having made almost 20% over 5 years. And really the bulk of these major core holdings in the IA community not really making much more than 5 or 6%. And then I compare ourselves to our people that view us our peer group, if you like. And so again, looking at, I've got 2 different sets of numbers here. On the first chart for 2022, I've got all of our liquid alts, so RP, YTM, and Algonquin compared to us. Clearly, we've outperformed all of these people in 2022. And on the chart, the 5-year chart, none of those other funds have been around for 5 years. So what I did was I took their OM products and compared our OM product, which is the first one, ECSC here, and then the liquid alt product in ECIAA, and I compared them to all of their OM products. And you can see our OM products smashed theirs, and our liquid alt products even outperformed theirs. So once we get a 5-year track record on their products, I'm sure that we'll be looking pretty good from a liquid alt standpoint in relation to them. So just from a performance standpoint, I think that we've kind of positioned ourselves as best in class over the last year and the last 5 years. And now I want to talk about our view on the market and where things go from here. So in January, we had this massive rally in rates. Okay, that rally in rates has probably been very helpful to most bond funds with rate duration. In fact, it's the best outcome they could have possibly hoped for. The problem with that is the chances of there being a sustained rally in rates over the next 6 to 12 months, I think is really small. And in February already, we've seen most of that 37 basis points trade away. Also in credit spreads have rallied a little bit as well through January. So that's been helpful to all the investment grade credit shops, including ourselves. And here's another performance chart, which I think is interesting, given what you just saw in the previous year's performance, where interest rates had caused poor performance for most of the other funds, but we'd managed to stay positive. You'd expect the opposite outcome this year. So here what I've done is I plotted last year's return on the left and January's return on the right for all of the same funds. So we made 2.3% last year. We made 2% in January. We didn't have any of the benefit from interest rates falling in January. Okay. The government bond index, which is a slightly longer duration index than the corporate bonds, made the most money in January, but lost the most money last year. But you'd expect those funds to make money in a falling rate environment. The corporate bond index ETF, same thing. They lost 10% last year. They made 3% in January. Well, they had an unbelievable month in January because rates dropped 37 basis points. That's not going to be repeated very many times. And as I said, in February, they're probably already down 1.5% to 2% in February. Same with Manulife. Manulife's up 2.7%. They were down 9%. They're also probably down 1.5% to 2% in January. So I guess what I'm trying to show here is that, you know, these funds are all slaves to interest rates, whereas we have a very high yielding product that's performing very consistently, positively, not in a volatile manner, and we're going to earn 8, 9, 10% in the next 12 months. Here's a slide that talks a little bit. I kind of let that the number out of the bag before I got to the next slide, but this is a slide that talks about performance after periods where credit spreads have peaked in the previous cycle. So here I've got the credit spread peaking in the end of 2016, credit spreads peaking a little bit during the Powell pivot in 2018 in COVID, and what I think is another credit spread peak right now. And so if you look at the green shaded areas, that's the 12-month period after credit spreads peaked in the previous cycle. So after the peak in early 2016, this fund made 15%, 14.6%. After the Powell pivot in 2018, it made 7%. After the experience of COVID, where credit spreads really blew out meaningfully, it made 22%. And we believe we're in another cycle peak right now. And in November to January, this fund's made 4.7%. And like I said, I still think that we're going to make another 8, 9, 10% in the next 12 months. And this slide here gives you an idea of why I believe that. So this is quarterly, the yield at the end of each quarter, going back to December 2021, and then where the yield stood at the end of January. So back in December 2021, our exposure was low, opportunities weren't very high, credit spreads were low, leverage was low, and the return on the fund was low. In March, it was to move from 2.2 to 5.6. We didn't change our exposure at all at that point, but credit spreads widened to the point where, you know, the yield was starting to look attractive. By the time we get to June, yields were at 7.6%. At that point, spreads continued to widen, but we also continued to, we started increasing our exposure over that quarter. In September, the same thing happened again. We increased our exposure, credit spreads continued to widen. And they widened up until the end of October. During the Q4 of last year, we kind of had our peak exposure, and you can see the yield on the funds at 9.6%. The last slide showed you that we'd made 4.7% from November to January, but you can see that the return or the yield in the fund has only dropped from 9.6 to 8.7%. With an 8.7% yield in this fund, you know, we're generally returning numbers over and above that yield. So we're very optimistic about the return potential of our strategy going forward for the next 12 months. And with that, Robin, I've probably used up all my time, and I'll hand it back over to you.
Mike, just on that last slide, if you could go back to it for 1 second, can you talk to me a little bit, or talk to the group a little bit about what that 8.7% means in terms of protection should credit spreads retrace?
Yeah, so So if you think about our fund right now is carrying about 8 units of credit duration. So just quick math, 8 units of credit duration, if credit spreads go up by 100 basis points, that's a loss of about 8%. So if you go through, you know, have a credit spread widening of 8% of 100 basis points over 12 months, you're still going to have a positive return. And just to put that into perspective, you know, your credit spreads in COVID were at about 240. You know, right now they're at about 120. So you're almost covered for a move back to the Ys during COVID. Almost, not quite.
And
so pretty
just
safe.
A little further down that same path, do you have any sort of view in terms of what you expect for the credit spread characteristics to look like through 2023? Are they a steady line towards maturity? I mean, you know, I know the math works out that way, but the journey in the actual marketplace may be different. So do you have any color you could provide on that in terms of expectations?
Yeah, I do. I think that credit spreads have moved in quite a bit in the last 2 or 3 months. And, you know, I think that's mostly been because the view has been that the central banks are kind of finished the heavy lifting and that they're going to be, you know, leaving the markets alone for a little bit. And so, you know, my bias is that credit spreads likely are going to trade okay for the next 2 or 3 or 4 months. And then as we realize that inflation is not going to go away as quickly as we thought it was going to go away, I think as you get into the summer and maybe into the fall, that central banks are going to either not stop raising rates or they're going to have to reinitiate tighter policy to get inflation really down to the targets that they're looking for. But I think credit spreads are going to stay relatively elevated. So I'm actually quite hopeful about that from a strategy standpoint as well, but I do believe that's actually what's going to happen. And so all that does, it extends the period in which you get those extraordinary returns, if you like. So right now we're getting 8.7% yield. You know, credit spreads come down a bit. That gives us more return. If they go out a bit, it gives us less return. But I think if we look over the year as a whole, we're probably going to see credit spreads not fall too much. They're likely to fall a bit here in the beginning of the year and then retrace a little bit in the back of the year. But that's just going to extend that period that you receive that return for, in my mind.
Okay. We had one question come in about optimization of overall return based on the shape of the credit curve. Are the credit curves much steeper in the short end now, sort of in concert with where short rates are? Is there a relationship there, or is that? Explain that a little bit, or is this pretty typical of how a credit curve looks?
I mean, what's happened with the credit curves, I mean, very good question, by the way, from wherever it came from. But if you think about the rate curve looks like this. The yield curve on bonds, on investment grade credit, kind of looks like that. So the difference between this and that is credit spread, right? So because the yield curve, the interest rate curve is so inverted, the credit spread curve is much steeper than has been historically. And so that's one of the reasons why, you know, the yield is so elevated, because you're earning more. This page here, or this example I was showing you, that's more, you know, obviously the yield here is 6.8, not 8.7. This is kind of an illustration of what it is normally. And so, you know, obviously the curves are steeper and credit spreads are more elevated today than they are in this example. And so that's one reason why I'm so optimistic about returns going forward. The other one is kind of goes along with this. So I'm sorry to make this complicated, but I'll try not to. But if you think about it, if you invest $1 with me, I buy a corporate bond with that $1. So I don't have $1 anymore. But then I sell a government bond and I get my $1 back. Okay, so now I have $1 and I've got 2 positions that leave me with this green credit box. What I do with that $1 that's left is I put it on deposit, right? So right now, because the rate curve is so inverted, I'm depositing that money at the highest possible yield, right? Because nobody's getting a higher yield than me. So I've eliminated the interest rate exposure and I'm getting the highest possible yield. If I'm an index buyer and I'm buying a 10-year bond, 10-year bonds are yielding 3%. So I got to take 10 years worth of interest rate risk, and I'm only getting 3% for it. Whereas I'm taking 1 day worth of, or 1 month, let's say 1 month worth of interest rate risk, and I'm getting 5% for it. And so those are the two main reasons why our fund is yielding so much more than all the other funds. One is because the credit curves are so steep, and the other because I'm getting the maximum return for my short dated deposit. Whereas most other funds are stuck, you know, buying wherever their duration index is, and you know, that's just not working out for them at the moment.
We had another question come in here, actually 2 questions. The first one I can answer, it related to liquidity. The liquid alt does have daily liquidity. I should reiterate that. The OM product that is offered directly by East Coast is a weekly liquid vehicle. And that is part and parcel of why the returns are different, but we can leave that just for now. I just wanted to make the point that this liquid alt vehicle is a daily liquid purchase and redemption vehicle. Second part of that question was, how do you use leverage, Mike? So I think if you could go to that next slide and just explain your, I buy a bond, I sell a Canada, and how many times you can do that. That I think helps to identify how the leverage gets used.
Yeah, so effectively what this group of trades does for me is, first of all, it eliminates the interest rate risk. Second, it creates a financing of my ability to create leverage. So in the liquid alt rules, you're only allowed to apply three units of leverage. And so that's why, you know, when I go through this, we use four times as the maximum. So 1 is your unit of cash, and three times leverage is what the liquid alt rules provide for you. And so that's what buying this bond and selling the government bond does. It helps create that financing vehicle for you. So that's how much leverage we take. That's how the leverage is created. And, you know, we feel relatively comfortable about that because, you know, the banks view this, or the prime brokers view this product as a product that they're happy to lever up to 12 times. So we're nowhere near any sort of leverage constraints. And the fact that nobody's actually lending me any money to execute or perform that leverage really takes the risk out of it, in my opinion, because no one's going to be calling me up looking for their money back. It's not a margin loan, so they don't need to get their money back.
Good. Okay. On the aspect of risk, how much risk are we taking as an investor when we own strictly credit spreads versus an outright bond? Is there a big difference?
Well, in terms of risk, when I think of risk, I think of price volatility. So how much can the price change?
Yeah.
So if you go back, you can go back as long as you want, but you know, over a long period of time, the interest rate portion of the government bond is about 3.5 times as price sensitive or as risky or volatile as the credit spread piece is. So, and you saw that last year, right? So interest rates, you know, went up, whatever they went up, 180, 200 basis points last year. You know, even in COVID, credit spreads didn't go up 180 basis points. Like they might have gone up 100 basis points or 120 basis points. So, and that's a once in a lifetime scenario, whereas interest rates, you know, are moving around 100 basis points every year. And this month we had, last January, they went down by 37 basis points. So far in February, they were up by 25 basis points. You know, credit spreads have moved by 15 or 20 basis points in total over that period.
Yeah, so the short answer is considerably less volatility on price by virtue of not having a rate component.
That's right, yeah.
Okay, good. I think that pretty much covers the strategy, unless there was anything else that you sort of want to make sure people are aware of with respect to the strategy. Maybe just spend a little bit of time on how actively you guys work the book. I think that's important too, because to me, it just says you're doing all you can to maximize the return per unit of risk.
Yeah, so I mean, one of the things that I didn't talk about in the mechanics of the transaction or the strategy of the fund and mechanics of the fund is this little green triangle here that we talked about, which creates all of that return, if you like, or that capital gain, really free return, because you're not actually taking any additional duration to get that, you just get it over time. We don't wait a year to get that. So we instituted a system back in trading, real-time trading system back in 2016, which allows us to see exactly which bonds are the most expensive and which bonds are the cheapest on the credit curves. And so there's probably 3,500, 4,000 securities in the universe that we trade, and being able to determine which ones are cheap and which ones are expensive is really important in terms of being able to monetize that capital gain. So if you just think about it, if this is my credit curve and this is the 2-year point, and roughly 50 basis points return or 52 basis points return is that's a basis point a week, but it doesn't actually show up as a basis point a week. Some months you might show up and then the curve just kind of goes sideways, there's no change in shape of the curves, you haven't made any money. Then other weeks you come in and the curve goes like that, and now the curve's completely flat. So that means that 52 basis points of capital gain, you've actually made that, right? Because mark to market, the value of that security is now that 52 basis points more expensive. So at that point, we sell these bonds and we buy 3-year bonds or 2.5-year bonds. And now we get an opportunity to earn the steepness of that credit curve again, as this part of the credit curve flattens. And so we're basically doing that every day in little pieces. So we'll buy a bond that's 10 basis points cheap to that credit curve, and then we'll sell a bond that's 10 basis points expensive to that credit curve. And so the curves are kind of doing this all day long and all week long. So we're usually able to generate that capital gain without any more duration exposure a couple times, maybe even 3 times a year, depending on the circumstances and how lucky we are, if you like. And so the portfolio is very active in that regard. It turns over 25 times a year. So twice a month the portfolio turns over. But it's also very active in terms of overall duration exposure. So last September in 2021, we had our lowest duration exposure ever. Our view was that you weren't getting paid very much for the risk you were taking. Our view was that inflation was not going to be transitory, it was going to be a problem, and we wanted to take our exposure down. And so we had the portfolio was probably only 35% exposed at that point. That's one of the reasons when credit spreads widened so much in 2022 that we didn't take losses. Now, you fast forward to July, August, September 2022, we're at about 120% invested. The credit duration is up around 8 or 9. And so now we're able to take advantage of credit spread narrowing with a much larger credit exposure. And so there's 2 ways that we're active in the portfolio. One is actively trading day in and day out to capture that capital gain. And the other one is to de-risking the portfolio when there's higher risk in place and not enough return, and aggressively taking positions in the portfolio when the return opportunities exist.
Okay, good. I think that pretty much exhausts the update. That's a great update. Maybe just way of summary, Mike, I want to make sure I have this right. So we only invest in investment grade bonds, number one. So there's really no risk of default on the part of the issuer, all things being equal. We have a credit spread environment that's quite favorable, i.e. credit spreads in investment grade are relatively wide, so there's an opportunity for those to be capitalized on. What, if anything, do I need to be worried about as an investor in this fund? Like, what's going to bite me in the butt, if anything?
So to me, there's right now, given how elevated credit spreads are and how elevated cash rates are, there's very limited downside. So you're earning a yield of almost 9%. That yield protects you against credit spreads widening up to about 100 basis points. Credit spreads are elevated historically, so the probability of them rising is probably less than the probability of them falling, and that's also good for you. And the last thing I would say to answer your question, but your only real risk here is credit spread widening. And in the event of credit spread widening, you have such a massive yield that to effectively buffer you against that you don't normally have. So, you know, you might feel like you're taking a lot of exposure and that it's a risky environment, but it's actually the opposite. You're not taking much exposure, and it's a very benign environment because of that buffer you have on the yield that you're earning. And so those are kind of the three takeaways for me. And really, at the end of the day, if you're not investing in this product right now, you're probably never going to invest in it, because you're not going to get many opportunities that are better than better than the one that you're seeing today.
Good, I agree. All right, let's leave it at that. Thanks very much, Mike. I appreciate your time as always. Folks, if Mike, if you can just flip to the very last slide, I would bring attention to the fact that all of our contact information is there for the local people in local areas across the country. Please reach out. We can provide you with additional information. If you have additional questions, happy to answer those. But at this point, I'll say thanks very much to Mike, and we'll sign off here and look forward to continuing our conversation in investment grade credit with all of you. Thanks very much.
Thank you.